Good morning, good afternoon, good evening, depending where you are on the planet. And welcome to the Thursday, the 23rd of June, Bull versus Bear webinar. Steve Marley on the call for trade day. Just a heads up, guys, it's going to be a very brief webinar in there today. Unfortunately, I have a commitment, but there's not a huge amount to say. But I'll run through what we have on the calendar. I'll run through the macro fundamental geopolitical events that could be macroeconomic events that could be influencing markets right now with the news headlines, and we have a very whistle stop tour look at some charts to see where the opportunities are. Any questions, as ever, guys, please put them into the chat as we go. I'm going to be limited on time today, or email them in if you've got anything you want me to discuss on the webinar. If there's particularly, if you want me to look at an indicator, if you want me to look at, I don't know, some chart patterns, do a little a little bit of education on something, on the charts, on candlesticks. I don't know what it might be. If it's a macro fundamental question, if it's a question about correlations between markets, fire us an email, support at info at trade day, Steve at trade day, whichever one.com. Okay, trade day.com. You can send it to support at info at Steve at, I don't care which one, I'll get it. And then I can cover it in the webinar going forward. Make sure you're on the webinar, obviously, or pick it up on the recording. Right, let's take a look at the calendar, what we've got coming up. PMI day today. So we've got, it's now owned by, it used to be market PMI. Now we have it as S&P PMI, Purchasing Managers Index. This is the flash PMI data. So we don't get the ISM. Usually when we get the market data, the market slash S&P data, we also get the ISM data when the forward data comes out. It comes out on the same day, the ISM 15 minutes after the market slash S&P data. However, this is the flash PMI data. This is the heads up. This is the preliminary data for June. We're not at the end of June yet, but this is getting 80 to 90% of the survey responses on the PMI data. Remember, it's Purchasing Managers Index. It's a survey of purchasing managers. So it's we don't get that from the ISM, the Institute of Supply Managers. The Institute of Supply Managers in the US is the more important data, but the global data that we get from market slash S&P is important as well. And if you look at what we've got, you can see a sea of red in here mostly. Okay, so for France, Germany, Eurozone as a whole, and for the manufacturing part of the UK, the composite and the services were positive on the UK, but for the rest of Europe in here, the core of Europe, certainly negative, missing expectations. Okay, and they'd already been ratcheted down, obviously, with everything that's happening right now. So the numbers were already, the forecast numbers were have been ratcheted down, were lower than you can see them previously, the previous numbers. So the forecast numbers have been lowered, and we missed on the forecast numbers. Some of these are actually quite negative in here. So that's a real disappointment in here that we've seen so far this morning with those European PMI data. We also obviously get out the US versions in here. So they're not looked at as much as the ISM data, but given we're not getting the ISM data because they don't forecast these what they call flash PMI, the preliminary data, we're going to be watching these anyway, right? So we got those out. Those are at 0945, 9:45 this morning, Eastern time, okay? Looking at the manufacturing, composite, and service sector PMI. Just after that, at 10 o'clock Eastern, Powell testifies again to the House, I think, today. Was it the Senate yesterday, House today? Never, whatever, Congress. So again, any Q&A is going to be important. Let's take a look at what he said now. So Powell yesterday did actually get the market to give it a boost yesterday initially, although the market dropped into the close. US stocks then down slightly. So this is a recap from yesterday after early boost from Powell. And oil was lower, oil lower again in here, significantly lower, another 3% down in here this morning. But just going back to a quick note on the euro. The euro is lower against the dollar in here this morning on the back of that PMI data. Although saying that, the dollar is up against pretty much everything in here this morning. So we're going in, it's kind of a bit of a strange day in this morning because we're kind of going a little bit into risk on the dollar rallying against most currencies in here. So sorry, risk off. Sorry, from the FX side. If you look at the stock indices are rebounding in here. Europe initially lower and has rebounded a bit. US futures are rebounded, having dipped back lower yesterday. So US stocks initially were up, got a boost from Powell. So Powell basically said that he's committed to bringing inflation down, so the market wants to see that. And he also said that he felt that the US economy was resilient enough to cope with the rate hikes that were coming through, to come through. So all of that was kind of positive initially from Powell. but then the market kind of ebbed back lower into the close, and we ended up just pretty much unchanged on the day, kind of initially down, then up again. We were down from the European session, pre-market, rebounded through the session, then drifted back lower, but then up again overnight in here. Let's take a look at 5 things you need to start your day in here. So the focus today really going to be on that US PMI data, going back to the calendar, and Powell speaking later. Is he going to give us anything else? Is he going to give us another positive as we saw yesterday? Right. So 5 things you need to start today. Jay talking Federal Reserve Powell's testimony is strong. He said did little to ease fears that he goes at risk of falling into recession. He said engineering a soft landing where inflation is taken back under control without causing growth to fall is very challenging. Okay. But nevertheless, he's back in front, back in Congress today, 10 a.m. Eastern. We've already spoken of that. Raw material, we're seeing commodities falling significantly lower in here. Oil, copper, wheat prices all pushing lower in here, been falling all week. Now, you could say that's concerns about recession, but then equally that's going to take off inflationary pressures, right? So for now, those sinking commodities mean one element of inflation is in retreat. So, it's got a double-edged sword there. Germany warns that Russia's move to slash European natural gas supplies risks a collapse in energy markets, drawing a parallel to the role of Lehman Brothers in the financial crisis. So that's a bit of a dire warning in here coming out of Germany. And riskier assets. So it said sold off for the weaker than expected preliminary. So riskier assets in Europe, equities dropped. With those negative European PMI data, but have had a little bit of a bounce back. But what we've actually seen is then bonds rallying, bonds going up, bonds rallied, 2-year German yields going higher, cratering over 20 basis points. So that means bonds up in price, down in yields. Okay, so kind of like a safe haven bid. But again, that higher bond prices, lower bond yields is actually then kind of positive for stocks as well. So it's kind of a little bit cyclical in there. Again, double-edged sword. We've already spoken about Powell, and we get that ISM. Sorry, not the ISM data. We get the PMI data later today. So look, bond yields sink on recession fears. So bonds are being bid up. People are buying bonds because of recession fears, as a safe haven. However, that sends yields lower, which is kind of then supported, particularly in the Nasdaq. You've seen the Nasdaq do well overnight. Rising odds, Fed will pivot back to easy policy by May 2023. So with all the talk of hikes, we're talking about risk of Fed easing, before this time next year. Okay, within whatever that is, 11 months time. Oil getting hit again, recession fears hitting commodity markets across the board. As we said in here, we are down again, 15% since June the 8th. Okay, so in the last couple of weeks, we're down from the peaks in here, 15% on WTI oil. European stocks skid on gloomy business activity data. That's the PMI data. Commodity weakness as well, hitting the commodity stocks and the energy sector. And the UK economy running on empty as recession signals mount. PMI data. Well, yeah, it says that, yeah. But remember, the UK PMI actually was the only ones that really kind of beat in some places. Manufacturing is worse than expectations. But these numbers, what they're saying is the absolute numbers, even though we beat expectations, the absolute numbers are very negative, and they are pointing towards potential recession. Okay. What else? Recession fears stalk oil, copper, and stocks. We've already spoke about that. And here's the tail of the tape. So, even though European stocks, a lot of this spin's written with European stocks down. Well, you can see now they were down. They have rebounded in here. So we have seen a rebound in stocks in here in Europe this morning. So we're kind of mixed. We were a lot lower than this. I'm not sure we can see in here. We'll go and we've got the AEX in here. If I go and can we just click through? Let me just take a look at something like what's so the CAC is actually up to there. So I've got even the DAX in here, which is 0.4 down. But you'll see in here, it's got the intraday chart. Oh, no, it doesn't show the intraday chart. I'm just showing a daily chart in here. That's not really doing us any use in here. But, certainly the market has dipped and rebounded. European markets have dipped and rebounded in here this morning. And if we look at the US stock futures, we were down, but only just slightly yesterday. So we were down initially on the, in the pre-open on US futures yesterday. We dipped, we rebounded into the session, through Powell, got a bid through Powell, and then drifted back lower to, you can see effectively closing unchanged. We're like a 10th down on Dow and S&P. And this morning we're up, over 0.5% on the major averages. On the S&P, Just over half a percent, just under on the Dow, and nearly 1% higher on the Nasdaq. Nasdaq benefiting from the fact that we're going to higher bond prices, lower bond yields. Remember, the Nasdaq growth stocks more sensitive to interest rates. Right, let's take a look at the charts. So there's that kind of erratic day yesterday. It's the S&P. Sorry, forget that. It's not. It's the Nasdaq. Let me look at the S&P first of all. So the S&P, there's the erratic day. We were down initially. We got a bid through power and then set back to close pretty much unchanged. But you can see today already having opened and dipped lower with the European equity market weakness this morning. The market's rebounded. We're back on the S&P up near yesterday's highs. I'm fully anticipating a break above yesterday's highs and up towards these two peaks here. And if we zoom in again, what do we have building in here? Well, we already looked down here at this double bottom, or you got almost got a double-headed, double-shouldered. Sorry, not single-shouldered, double-headed head and shoulders bottom in here. So in here, you can even look at this as a shoulder and a head and a shoulder, or you can look here, shoulder. You could argue, but where are we? I'll do this real quick, so I am pushed on time a little bit, guys. But you could argue your little shoulder here. Then you got two heads. Whoops, that didn't work very well. You've got kind of two heads here. Head there. And another head here. And they're a bit wider. And then you've got another shoulder here. Actually, I can just duplicate this. These are going to be easier, I think. You can duplicate these, can't you? I'm sure you could duplicate these. I'm sure I was playing with this earlier on. It allowed you to duplicate it. No. Okay, forget that. Let's do it the long way. And you got another shoulder over here. Okay, you've obviously broke the neckline. You would argue, where's the neckline? Well, it's through the shoulders. No real neckline, but certainly through there was important. And you can see the market's dipped back down and rebounded out there. So you got that inverse, double-headed inverse shoulders. And then since then, you got higher highs and higher lows. Okay, so if I get rid of a lot of this old analysis in here, what we have now is you have this uptrend coming off of this low through here. We extend that out. And then you got another one up through here now. And then if you had any counter trend line, look, really strong impulsive rally this morning for the last 2-3 hours, really strong in here. Rejecting that. So you had initial weakness on the European Open, rejecting that. The market's really tore back significantly higher. And then, I think we're going up to yesterday's peak. And then you got these peaks over here. So I think this is a real target area up at 38.30, 38.40. And if it can clear there, that's the post-Fed. That was Fed last week when we were very erratic. You can see there in the Fed. That's where we got up to, and then we failed miserably on the Thursday, right? So that peak there, I think we can have a go at that peak today, and that is 38.43. So I'm certainly bullish. I think it's been a really strong, given the PMI data out of Europe was not great. I think there is an element of, these falling commodities is actually going to end up being, positive, kind of thing. So, and the market's looking at that. And it's certainly, I think it's looking at this as well, bonds, we've spoken about bonds. Broke out higher yesterday, pushing higher again today. Higher prices, lower yields. Lower yields are constructive. So even though the bonds are going up because of recession fears, it actually helps equities, so they can go up together. So there's the S&P, and if we go to the Nasdaq, it's looking even better, as it should. Those peaks in here from last week are even closer. They're there, right? So you failed there just yesterday. Those are the peaks. Those are the Fed peaks. That's the Fed high there, that green candle there. And then the market, pushing back high. And if we go and take a look on 15-minute, again, I'm not going to do it. Let's get rid of all this old analysis. In here, you got the basing structure down here we looked at previously, and you got these, you can imagine various trend lines coming up through here, and we're impulsively back up to the highs. But then the peak in here just from yesterday, you can see just below the peaks in here. That's the Fed peak there. So that Fed peak is up at 11,794 and a quarter. So up through 11,800, this is looking really good again, and I easily see us having a go there. So for me, the only problem you've got in here is you're buying this, you've got a really strong run. This is a 15-minute chart. So last 2 to 3 hours in here, we've been boom, 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 straight up in here. Got this really impulsive candlestick. I'm not sure what that came from in here. That was at 9 a.m. this morning. It wasn't the data. Oh no, because the data wasn't good, right? I'm not sure where that came from. I'm not sure where that impulsive candle came from, what if that was news driven or what that was. But we certainly saw a really strong move there. That's 9 o'clock my time, by the way. 9 through 9:15. I'm not sure if that was breaking news there or not, but nevertheless, since then there's been one-way traffic, and it looks good, and I think have a go at yesterday's higher and then quickly above. Any kind of dip pre cash market open, pre the US cash market open, I think is a buy back into this like 11,650 to 11,600 area, somewhere in here, looking at as a buy opportunity for the next leg higher. It certainly all just looks bullish to me. Let's take a look at the commodities. So oil, despite the bounce today in here, we're looking to fade this bounce. So really aggressive move lower. We said we didn't want to sell into it. It was down here when we were on the call yesterday. We said there was no point in selling into it. It looked, it had already done what it needed to do for the day. We've had the bounce, so there, where were we yesterday? So let's take a look at where we were yesterday when we came on. Where were we? We were here, I think. No, that's overnight. What is this? Hold on a second. 1 hour chart. We were down here, I think. Yeah, we're basically here. So it only rebounded, but you can see rebounded, failed. It's rebounded again. I'd be waiting for this rebound to run out of steam and looking to fade into this. You could be having it setting up as a little double bottom down here. This is on the 1 hour chart in here for oil. But if I zoom in a little bit, 15. I'd be looking to fade this, I think. Fade this rebound. It still looks fairly negative to me overall. This is far more influential than this kind of rebound in here. So, yeah, still very negative from my perspective. Let me get rid of all the... Yeah, still looks negative in here. And if I take the... Let's have a look. So I'm going to just zoom out to the 30-minute chart. Yeah, I mean, if you look at the downtrend line, it's very much intact. You got that through there, but then if we go more accelerated, and the market came up to there, that was like overnight and yesterday, and failed, and then today. So yeah, I mean, looking for it to fail around 106 really, 106.00, and certainly below that high there at 107.29. So sell zone is between 106 and 107.29. Above 107.29, I'm happy to reverse into a long. So short between 106 and 107.29, or reversing into a long above 107.29. Maybe looking to enter the short on a break of this kind of little counter uptrend. Either here, but probably better one is the more accelerated through here. Back down through here, so through like 104. Maybe it's too late then. But yeah, maybe zooming in a little bit more in here onto the 15 and looking for a trigger point. Yeah, there's nothing really in there. Maybe through that little low there. 104.99. So back below 105, it looks negative. Or up in sell zones up in here somewhere. Or down through 105. Gold. Sideways city. Inside yesterday's pattern. Negative. Going into today. Yeah, it looks vulnerable. I've been holding on to a bullishness on gold. But, yeah, that looks vulnerable, that low. If it takes out yesterday's low, which is 18.24.5, it looks vulnerable for $10 lower to 18.15, 18.14 to these lows over here. And, it certainly looks like it's going to attack that. And it's not being helped by the dollar. Dollar's strong today, and I'm not quite sure where that's coming from. I think dollar's strong more like because euro's weak. Euro's weak. Sometimes this happens because the euro is so dominant. The EUR USD is such a dominant trading pair. If euro goes lower, and euro's gone lower because of the poor PMI data. So poor PMI has led euro lower. So EUR USD goes lower. When EUR USD goes lower, often it means it drags a lot of other currency pairs. So EUR USD goes lower for a euro reason. It's not dollar strength, it's euro weakness. But because of that, then you get broad selling of other currencies against the dollar. So EUR USD goes down. Well, if euro dollar's going down, shouldn't Aussie be going down? Shouldn't the pound be going down? Shouldn't Kiwi be going down against the dollar? So they go down as well, even though the reason euro's going down is not because of dollars. Normally, the currencies often can go up and down with dollar strength, dollar weakness. But this, I think, is being driven by euro weakness, which is actually translating into EUR USD weakness, and then EUR USD weakness is being interpreted as dollar strength. So you're seeing other currencies rally against the dollar, and with the dollar other currencies weakening against the dollar, and with the dollar strengthening is putting negative pressures on gold. Okay. All right, I'm going to wrap it up there. I'm going to wish you all a great trading day as ever. Stay safe, and I'll be back with you with a bull versus bear webinar for tomorrow on TGI Friday. Take care. Cheers, guys.